Welcome back to the Deep Dive. Today, we're plunging into the latest numbers from the home building sector, specifically unpacking the second quarter 2025 earnings conference call from Taylor Morrison.
Yeah, we've gone through all the data, the balance sheets, management commentary, the whole Q&A session, really trying to distill the most critical insights for you. Their Q2 results give us a pretty detailed look at how they're navigating, well, what's undeniably a complex housing market right now.
Right. And our mission today is to cut through all that jargon, the financial noise, and just deliver the essential takeaways. What really matters for understanding Taylor Morrison's recent performance and, maybe more importantly, their future outlook.
Exactly.
So let's start by laying out those headline numbers from Q2.
Okay, so Taylor Morrison delivered, well, a strong quarter. They largely met or even exceeded their own guidance across nearly all key metrics, which, that's pretty significant in today's environment.
Definitely.
They delivered 3,340 homes. That's actually a 4% increase year over year.
A 4% increase in deliveries. Yeah, in this kind of market, that sounds pretty impressive. What did those homes sell for, and what did it mean for their, top line?
Well, the average price came in at $589,000. That was actually slightly ahead of their guidance of $585,000.
Okay.
So this translated into roughly $2 billion in home closings revenue. That's up 2% compared to a year ago. Now, that 2% growth, it might seem kind of modest on the surface, but I think it really underscores their ability to maintain that revenue momentum. It suggests their targeted approach is, well, working, navigating headwinds and capturing demand where it exists.
That's solid on revenue and delivery. What about profitability? Their adjusted home closings gross margin landed right at 23%. That was in line with guidance, correct?
Exactly, 23%, perfectly in line. And on operational efficiency, like SG&A, they also did well.
How well?
They achieved 90 basis points of SG&A expense leverage. That's, almost a full percentage point improvement. SG&A as a percentage of home closings revenue came in at a lean 9.3%.
Pretty efficient.
Very. Net income for the quarter was $194 million, or 1.92 cents per diluted share. That's a nice little bump up from $186 million a year ago.
Okay.
And if you look at the adjusted net income, which excludes certain charges, it was even stronger. $224 million, or 2.22 cents per share. That's up from $197 a year ago.
So that increase, especially with rising costs and maybe a cooling demand environment, that signals pretty robust operational efficiency, right? Good cost management.
Absolutely. It's a critical differentiator, I think, for investors looking at the space.
Okay, so we've got solid revenue, impressive delivery, strong profitability. But the thing that really caught my eye, and maybe yours too, was that dip in net orders.
Right.
That seems to indicate a significant shift in demand. What's driving that, especially when deliveries are actually up?
You're absolutely right to pinpoint orders. Net orders did see a dip, came in at 2,733, which is down 12% year over year.
4%.
Yeah. And the monthly absorption pace also moderated, down to 2.6 net orders per community. So it suggests that while they're, efficiently closing homes from prior quarter sales, the immediate demand environment is, well, it's cooling. And that's exactly what we need to dig into.
Absolutely. That orders dip feels like the key to understanding their current strategy in what management themselves called a choppy market.
Yeah.
And one of those striking trends they highlighted was that big increase in spec home sales. Can you maybe just break down what spec homes are again for listeners and what this surge really signifies?
Sure. So spec homes are basically homes built speculatively, meaning without a specific buyer lined up yet. They're designed for quick move-in. So they're building homes they expect to sell quickly rather than waiting for a custom order.
Got it.
And the surge was, well, dramatic. Spec sales jumped to a new high of 71% of orders in Q2. That's up from around 59% just a year ago.
Oh, 71%.
Yeah. And looking at closings, specs were 65% of the total. So this shift is clearly driven by, consumer preference for homes they can move into quickly and probably the incentives available on those ready-to-go units.
Right.
But the real insight here, I think, is how Taylor Morrison isn't just reacting. They seem to be strategically optimizing their inventory. This lets them capture immediate sales while maybe competitors are stuck waiting for to-be-built orders. It gives them a bit of an edge, potentially.
Even if it means,
a temporary calculated dip in gross margin on those spec homes.
So it's a strategic trade-off then. Capture immediate sales with spec, even if margins are a bit lower. How's management forecasting that margin impact for, say, Q3 and Q4?
Well, they were pretty explicit about it. They said this mix shift specs, generally having lower gross margins than the to-be-built custom homes, is expected to impact Q3 and Q4 margins.
Okay.
They're anticipating adjusted gross margin to moderate sequentially, probably down to around 22% in Q3, and Q4 also expected around 22%.
So a full point lower than Q2.
Sequentially, yes. But importantly, for the full year, they're still projecting adjusted gross margin to be approximately 23%.
Ah, okay. So they expect the annual average to hold up.
Right, which suggests maybe some normalization later or other levers like cost management or maybe some pricing power in other segments helping out the annual average.
Interesting. Okay, so despite that market choppiness hitting orders, their land pipeline sounds really healthy. 85,510 lots owned or controlled.
Yeah, that represents about 6.4 years of supply based on their trailing 12-month closings. Pretty solid.
And they're moving towards that goal of controlling more lots through options, right?
Yeah.
Currently at 60%, aiming for 65%. That strategy, optioning land instead of owning outright, that helps manage capital and risk, doesn't it?
Precisely. It's a key capital efficiency strategy. Reduces the upfront cash outlay and the balance sheet risk.
So what was their land investment like in Q2?
In Q2, they invested $612 million in home building land. About 43% of that was allocated to lot development, so getting existing land ready. For the full year, they're targeting around $2.4 billion in total land investment. But they did note a potential downside bias to that number.
Meaning they might spend less.
Yeah, basically saying they're being extra diligent given the current market conditions. They also mentioned seeing some softness in the land market itself.
Oh, interesting.
Yeah, which actually provides opportunities for them to, maybe recalibrate deals or get more favorable terms on future acquisitions. It's actually a pretty good time for a well-capitalized builder to be strategic about land.
Makes sense. Now, beyond the big numbers, I was also struck by their focus on efficiency. You mentioned SG&A, but they also talked about improvements in stick and brick costs and cycle times.
Yeah, stick and brick are basically the direct construction costs for the house itself. They saw year-over-year improvement there.
Which is crucial in this cost environment.
Absolutely. And cycle times, how long it takes to build a home start to finish, improved by more than 2 weeks just sequentially in Q2.
2 weeks faster.
Yeah.
That's significant.
It really is. Getting homes to market faster is key for, capturing demand windows and reducing carrying costs. Plus, they mentioned their digital sales environment continues to drive meaningful cost savings.
So all these operational efficiencies, they directly help maintain those healthy gross margins we talked about, even with that spec home mix shift.
Exactly. They're direct contributors.
Okay. And what about their financial services arm? That also seemed like a strong performer, maybe a key differentiator for them?
Definitely a differentiator. Financial services revenue was up to $53 million, and get this, with a gross margin of 51.1%.
Wow.
And they achieved an 87% capture rate, meaning, a huge percentage of their home buyers are using their in-house financing.
That's a high capture rate.
It is. And critically, their customers showed very healthy credit metrics. Average credit score, 751. Average down payment, 22%. And average household income, $188,000.
Okay, those are really strong buyer demographics for this market. It almost makes you wonder if they're intentionally targeting a more resilient buyer or if their product just naturally attracts them.
I think it's probably a combination of both, really. Their diversified product mix, especially the focus on move-up and resort lifestyle communities, naturally draws a more affluent customer.
Right.
And that customer base, combined with their strong balance sheet, provides significant resilience. Speaking of which, the balance sheet does remain robust. $1.1 billion in liquidity at quarter end.
Okay.
That includes $130 million in unrestricted cash and a hefty $952 million available on their revolving credit line.
Plenty of flexibility there.
Yeah, and their net home building debt to cap ratio was a healthy 22.9%, plus no senior note maturities until 2027. That gives them significant financial flexibility.
And that flexibility, it's not just about weathering storms, right? It gives them options.
Actionality. They can be opportunistic with land buys if the market softens further, or they can increase shareholder returns. It's a luxury maybe some competitors don't have right now.
And on that note, shareholder returns.
Yeah.
What's their stance on capital allocation? Share buybacks.
They're actively returning capital. Repurchased 1.7 million shares for $100 million just in Q2. Okay. And they still have $675 million left on their authorization. They're targeting at least $350 million in total buybacks for the full year 2025.
That's a significant commitment.
It is. And what's really fascinating is the longer term picture. Since 2015, they've repurchased about $2 billion worth of stock. That's roughly 60% of their outstanding shares over that period.
60%. Wow.
Yeah, clearly shows a long-term commitment to shareholder returns and, confidence in their own valuation.
Okay, so we've broken down the numbers, the operations. How does this all fit into Taylor Morrison's broader strategy? What did management share about their sort of long-term vision in this evolving market?
Well, management definitely characterized the spring selling season as muted and choppy.
Yeah, heard those words.
Due to, a mix of things. Stock market volatility, tariff uncertainty, immigration reform talk, and of course, those persistently high interest rates.
Right.
But, and this is key, they strongly emphasize their overall bias leans towards price and margin over just chasing pace or volume. They plan to leverage their attractive land positions and what they see as their discerning customer base. So it's a strategic choice, seems like, not just a reaction, a disciplined approach to profitability.
And a big part of executing that strategy seems to be their personalized incentives. They highlighted that 3.75% conventional 7-year ARM with no discount fees. That sounds like a pretty powerful tool for affordability.
It really is. That kind of rate significantly boosts purchasing power. Their example was it adds about $138,000 in purchasing power on a $500,000 home compared to market rates.
A big difference.
Huge. And what's interesting is how these targeted incentives seem to be helping them maintain margins despite the pressure. It shows a kind of granular approach to sales, offering tailored solutions instead of just broad price cuts.
Right. So if we connect this to the bigger picture, despite all these industry headwinds, their adjusted gross margin has stayed pretty stable, right? Range bound between 23% and 25% for the last, 2.5 years?
Yeah, that's right. And that is notably stronger than their historical average.
What do they credit that resilience to?
They mentioned improved scale, better operating capabilities, and importantly, that diversified product portfolio, serving a broad customer set.
The mix you mentioned earlier.
Exactly. 33% entry level, 50% move up, and 17% resort lifestyle in Q2. That diversification helps them weather shifts. For instance, while overall sales were down.
Yeah.
Their Esplanade communities, those cater to more affluent buyers. About 10% of their total business, they showed greater resilience. Net sales orders there declined just 8% compared to 12% for the whole company.
Okay, so that segment held up better.
Yeah, and those Esplanade communities also maintain strong gross margins up in the high 20% range. So it really highlights the stability and profitability coming from their premium offerings.
This raises an interesting point about consumer behavior. If sales are down overall, but their customer demographics are so strong, what's actually holding potential buyers back? Is it really about the economy for them?
That's kind of the crux of it, isn't it? A key takeaway they mentioned from their consumer surveys is that shoppers who are hesitating right now, they're primarily concerned with the overall environment.
Not their personal finances.
Apparently not their personal financial situations for the most part. This suggests there's potentially a significant amount of pent-up demand just waiting on the sidelines.
That would be correct.
Waiting for macro conditions to stabilize, for consumer confidence to improve. It suggests it's more of a macro issue than a personal affordability issue for their specific customer base, which could mean, a quicker snapback when the tide eventually turns.
That's a really crucial insight. Okay, another significant announcement on the call was that new $3 billion flexible finance facility with Kennedy Lewis for their Yardley build-to-rent business. What exactly is that?
Yeah, the Yardley build-to-rent. So this facility, they kind of liken it to a land bank. It covers both existing and new acquisitions. And importantly, it funds them all the way through vertical construction for their build-to-rent pipeline.
Okay, so what's the benefit?
Well, it's designed to enhance cash generation, provide some balance sheet relief, basically offloading some of the capital intensity of holding those rental assets long term, and optimize how they eventually dispose of or exit those assets.
So more flexibility in managing that BTR portfolio.
Exactly. They expect to exit maybe up to 4 communities from this program this year, allowing them to recycle that capital more efficiently.
Got it. Okay, let's shift gears slightly to regional performance. Where did Taylor Morrison see strength in Q2, and where were the pockets of softness?
Regionally, the Southeast looked pretty strong, especially Orlando, the Carolinas, Atlanta. They showed sales improvement and community count growth there. Sarasota also performed well.
And weaknesses.
Tampa was noted as an area of softness. Predominantly, it seems, in the first-time buyer segment there.
Okay. What about the West Coast?
On the West Coast, well, they've intentionally reduced their exposure in Southern California somewhat, but they said existing communities there are actually outperforming. And Northern California, specifically the Bay Area, sales were kind of flat year over year. But importantly, cancellation rates there were notably below the company average.
Even with all the tech noise, as they called it.
Yeah, even with the tech noise. So some resilience there, too.
They also mentioned the potential positive impact from the temporary lifting of the SALT deduction cap, right? State and local tax deductions.
Yeah, the cap being lifted, even temporarily. They noted it will primarily benefit markets like California and Texas, where you have higher priced homes and homeowners paying significant state and local taxes.
So maybe not a direct driver for purchase.
Exactly. Not likely a primary driver, but it could certainly contribute to overall consumer confidence, by improving household finances for that specific subset of buyers.
Makes sense. So putting it all together then, what's their forward-looking posture? How are they approaching the next few quarters?
Well, management stated the near-term outlook prioritizes patient growth. That was the phrase.
Patient growth.
Yeah. Focusing on capital efficiency, returns, rather than just chasing volume in this competitive market. They weren't ready to give specific 2026 guidance yet.
Understandable.
But they did express expectations for growth in the out years, as they put it, contingent, of course, on market dynamics stabilizing. So it's clear they're trying to play the long game with discipline.
All right. This brings us to the part of the show where we step out of pure analysis and into the realm of maybe speculative yet plausible trade ideas. And just a reminder for everyone listening, this is not financial advice. Please do your own research, consult your advisor, understand the risks involved.
Absolutely. Okay, so given everything we've heard from Taylor Morrison's detailed call, their strategy, here's an outrageous but plausible idea for maybe the more intrepid investor out there.
Okay, let's hear it.
With management explicitly stating consumer hesitation is driven more by macro sentiment than personal finances, and seeing their success with those bespoke mortgage programs like that 3.75% ARM,
Yeah.
I propose considering a tactical long position in Taylor Morrison, ticker TMHC, using call options that expire just beyond Q4 2025.
Okay, the outrageous part first. Betting long on a home builder right now in this choppy market with rates being such an overhang feels counterintuitive to some.
That's the outrageous part, yeah. Betting on housing when sentiment is maybe cautious, but the plausible angle lies in that combination of factors we discussed. Their robust financial health, that disciplined land investment, the success so far of their spec inventory strategy in meeting current demand, and those really strong consumer credit profiles they're reporting.
So the bet is?
The bet is essentially that the market is underappreciating the potential for that pent-up demand to re-engage fairly quickly once macro sentiment starts to improve.
Right.
And that Taylor Morrison's operational agility, plus that strong financial services capture rate, uniquely positions them to capitalize when that demand returns.
Okay. Any hedge or refinement to that idea?
Yeah. To make it maybe a bit more focused, you could consider pairing this long TMHC call position with a short position in a broad, maybe undifferentiated residential construction ETF.
So hedge against broader sector risk.
Exactly. Hedge the general sector risk, but try to amplify the potential alpha specifically from Taylor Morrison's perceived strengths and execution.
Interesting idea. Outrageous, but plausible indeed.
Yeah.
Okay, as we wrap up this deep dive into Taylor Morrison's Q2 earnings, it feels pretty clear they're proactively managing a very dynamic environment. They're not just sitting back.
No, definitely not. They're prioritizing margins over pace. They're strategically leveraging spec homes and those tailored incentives, and crucially, maintaining that strong balance sheet. It lets them navigate current conditions while still positioning for future growth.
Yeah, that focus on resilient, well-qualified customers and disciplined capital allocation really came through as key themes. And remember, again, everyone, the information shared here is purely for informational purposes. It is not financial advice. We really encourage you to dig into the details yourself. Form your own conclusions.
So what stands out most to you from this analysis? Do you think Taylor Morrison's approach is really a blueprint for resilience in home building right now? Or are there other factors you'd be watching maybe more closely?
Good question. For me, I'd be watching how that spec strategy really plays out into 2026, especially if rates stay elevated like this. And will those strong customer credit metrics truly hold up under sustained pressure.
Yeah, valid points. And what signals might we actually see that could tell us that broader market sentiment is genuinely starting to shift? That's the big question, maybe.
Fascinating points to ponder. Well, thank you for tuning into the deep dive. We hope this analysis helps you make sense of Taylor Morrison's latest earnings call. We'll catch you next time for another deep dive into the corporate calls that matter.